When it comes to investing, one of the most important metrics that I look at, regardless of whether the company is a dividend stock or not, is free cash flow. After all, free cash flow is what is used to pay dividends, buy back shares, pay down debt, and make strategic acquisitions. It is so important. And in today's video, we're going to take a look at 3 companies that have been generating huge amounts of free cash flow, and all 3 of these companies are trading at cheap valuations. And before we begin, do me a huge favor. Click that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your own due diligence and do not take this as financial advice. And I'd like to take a quick moment to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's get back to today's video, taking a look at 3 companies generating huge amounts of free cash flow, and all 3 look very cheap in terms of valuation. Beginning with stock number 1, which is Deere & Company, stock ticker DE. Deere & Company is an industrial play, more an agriculture play, but in years past, I have referred to them as the Tesla of agriculture due to the fact that they are implementing self-driving software into their tractors. Deere & Company has a market cap of $108 billion, and over the past 12 months, the stock is up 3%. However, over the past 3 months, though, Deere shares have retreated more than 15%. For the past 3 years now, not only has Deere & Company increased their profit margins for 3 consecutive years, their profit margins now are some of the highest the company has ever seen. Here's a look at the last 3 years. In 2020, profit margins were 7.7%. In 2021, up to 13.5%. And in 2022, the last full year, they were up to 13.6%. Revenues for the company have increased in 5 of the past 6 years, which have helped increase these profit margins. But again, profit margins are great, but something I care even more about, as I stated at the beginning, is free cash flow. And with the company implementing more self-driving software into its tractors, I would expect the profit margins and the free cash flow margins to just further increase moving forward. Here's a look at the company's free cash flow over the past 3 years. In 2020, they generated $6.7 billion in free cash flow. In 2021, $6.9 billion. And in 2022, free cash flow was $3.5 billion. So far through the first 3 quarters of the company's fiscal 2023, Deere & Company has generated $2 billion. Over the course of the trailing 12 months, so the 3 quarters so far in 2023 and the 4th quarter in 2022, Deere has generated free cash flow of $5.8 billion. Deere has 295.9 million shares outstanding, which translates to a free cash flow per share of $19.43. Over the course of the last 12 months, the company has generated sales of $61.4 billion, which equates to revenue per share of $207.41 per share. Using these figures, we can determine the company's free cash flow yield, which shows what percentage of a company's revenue is turned into free cash flow. As such, Deere currently operates with a free cash flow yield of 9.4% over the past 12 months, which is solid. Deere currently pays an annual dividend of $5.40 per share, which equates to a dividend yield of 1.4%. Using our free cash flow per share of $19.43, we can use this to determine the company's free cash flow payout ratio. After all, dividends are paid from free cash flow, and that payout ratio is currently at 27.7%, leaving plenty of room for dividend growth and showing that the dividend is quite safe currently. Speaking of that dividend growth, Deere has increased their dividend an average of 14.4% per year over the past 5 years. Now turning our attention to valuation, analysts are looking for 2024 EPS of $32.71 per share, which equates to a forward price to earnings multiple of 11.5 times, which is well below the company's 10-year average of 17 times. Analysts are also high on the stock with an average 12-month price target of $441 per share, implying 17.5% upside from current share prices. Cash flow company number 2 is American Express, stock ticker AXP. Many of you know American Express operates within the financial sector, but they're better known as a credit card company. American Express currently has a market cap of $104 billion, and over the past 12 months, the stock is flat. But as you can see from this chart, the company recently saw their stock fall 5% in one day and down nearly 20% in the past 3 months. Down 5% in one day? What happened? That's a great question. Actually, American Express just recently reported their Q3 earnings. So let's go through those earnings. The company reported EPS of $3.30 per share, but analysts were looking for $2.94, so a solid beat there on the bottom line. Revenues came in at $15.38 billion, which is pretty much in line with the $15.36 billion, a slight beat pretty much on the top and bottom line. The company has actually reported 6 consecutive quarters of record revenue, not just revenue increases, but record revenue for the company. During the quarter, card members continued a trend of strong consumer spending, evidenced by the global volumes being up 7% year over year, and spending by U.S. consumer card users was up 9%. One of the intrigues when it comes to American Express is the fact that they appeal to the affluent, the higher income class here in the US and pretty much globally. So if you're in the camp as an investor that believes we may tip into a recession, the higher income earners are going to be the least likely affected. So that's great for American Express and any of their provisions moving forward, or people not being able to pay their bills. Speaking of those provisions, American Express has built up a provision of credit losses of $1.23 billion, which was higher than the $1.19 billion that analysts were looking for, which suggests the company is either more concerned about a total recession or just being more conservative given the uncertainty moving forward. In terms of free cash flow, here's a look at how much AXP has generated in the past few years. In 2020, they generated $4.1 billion. In 2021, that blew up to $13.1 billion. And in 2022, even higher to $19.2 billion. American Express has generated more than $10 billion in free cash flow through the first 3 quarters of this year so far. And as of the end of 2022, AXP had free cash flow per share of $25.87 and revenue per share of $67.48. That has the company operating with a free cash flow yield of 38%, which is extremely high. AXP currently pays an annual dividend of $2.40 per share, which equates to a dividend yield of 1.7%. The company has a 5-year annual dividend growth rate of 10%. In terms of safety, though, the dividend appears plenty safe at the moment, with a free cash flow payout ratio of just 9.3%. Again, I don't like to look at the typical payout ratio. I rather look at the free cash flow payout ratio, because where are dividends paid from? They are paid from free cash flow. Now let's take a look at valuation. Analysts are looking for 2024 EPS of $12.40 per share, which equates to a forward price to earnings multiple of just 11.4 times, which is well below the company's 10-year average of 15.2 times. Analysts are also high on the stock with an average 12-month price target of $174 per share, implying 23% upside from current share prices. Now moving on to cash flow company number 3, which is AGCO Corporation, stock ticker AGCO. Now, many of you may not be familiar with AGCO, as they are actually a lesser-known competitor of Deere & Company. They're another tractor company operating out of the industrial or agriculture sector. The company currently has a market cap of $8.5 billion, and over the past 12 months, the stock has inched higher by 7%. But over the past 3 months, though, the stock has fallen nearly 20%. Outside of owning well-known tractor brands, AGCO is looking to step on the toes of Deere & Company and start implementing their own self-driving software into their tractors. Now, they're investing a lot into the company right now because of that. That's going to bring down the free cash flow, but these margins that the company is going to get once this is started to implement and start selling off, that is just going to blow up their free cash flow moving forward. So this one's, even though it's a smaller company, it has a ton of upside if they're able to execute these plans efficiently. Revenues have been climbing higher and higher for the company in 5 out of the past 6 years, including 12 consecutive quarters of year-over-year revenue growth. Here's a look dating back to 2016. The company generated revenues of $7.4 billion, and then $8.3, $9.4 billion in 2018, $9 billion in 2019, $9.2 billion in 2020, $11.1 billion in 2021, and $12.7 billion in 2022. As you can see, revenues have climbed 72% since 2016 and should continue climbing moving forward. Analysts are expecting revenues of $14.7 billion in 2023 alone, which would equate to year-over-year revenue growth of more than 15%. The company has generated the following free cash flow figures over the past 3 years. Now, again, a much smaller company, but still generating positive free cash flow is a great thing, regardless of how big your market cap is. In 2020, the company generated free cash flow of $0.6 billion. In 2021, $0.4 billion. And in 2022, free cash flow of $0.5 billion. Now, again, to be able to calculate free cash flow, you take cash from operations and subtract out what you're investing back into the business in terms of property, plant, and equipment. And AGCO has been doing a ton of that recently. AGCO is still gaining footing here in North America, but the company has some ambitious goals, which could explode revenues, leading to even higher free cash flow moving forward. Here's a look at the company's goals, one of which is the fact that they want to have fully autonomous solutions across crop cycles by the year 2030. In terms of the dividend, AGCO currently pays an annual dividend of $1.16 per share, which equates to a dividend yield of just 1%. However, in May of 2023, AGCO management increased the dividend by 20%, while also issuing a special $5 per share dividend as well. The company has used this approach for 3 consecutive years now, so it looks like it's starting to become regular. So if we include that $5 per share, AGCO actually has a dividend yield of 5.1%. In terms of valuation, analysts are looking for 2024 earnings per share of $14.99, which equates to a forward price to earnings multiple of just 7.5 times, which is well below the company's 10-year average of 15.7 times. In terms of price target, analysts have an average 12-month price target of $150, implying upwards of 33% upside from current levels. As you can see, all 3 of these companies are generating huge amounts of free cash flow, which allows them a ton more flexibility. Do they want to keep increasing the dividend? Do they want to keep buying back more shares, paying down debt, or making strategic acquisitions that will continue and speed up growth moving forward? This is all why free cash flow is so important. You have Deere and Company along with American Express, 2 well-known and much larger companies, and then you have the smaller or lesser-known company in AGCO. Down in the comments section below, let me know what you think of each of these 3 companies. And with that being said, if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel so you're notified anytime we drop new content. And with that being said, we'll see you in the next video. Take care.